The sell-off in equity markets in 2022 has been brutal, and there's been little comfort in bonds because they've sold off too. So in this video, we're going to look at the reasons behind that. We'll look at whether equity markets have now capitulated, but more importantly, we'll look at valuation because that tells us how low equity could go. And then we'll also look at a glimmer of hope for the future. So let's look at how low equity could go in a bit more detail. Let's begin by recapping what's happened already. Here are the year-to-date returns for 2022, and it has been brutal across many of the risky assets. The places where you could have found some comfort would have been oil, so the USO fund, for example, is up hugely year-to-date by 42%, and gold gave us a small positive return. And also short-term government bonds, so SHY, for example, only fell by 3%. Shocking for that fund, but not shocking for bonds overall. But after that, it's just a sea of red, whether it was corporate bonds, longer duration treasuries, so the 7 to 10 year is down 10%, emerging market bonds are down between 11 and 12%, and then in equity, we see emerging markets down 12%, the S&P down 13%, so that's a correction, and the Nasdaq is actually worst of all, that's down by over 20%, so that's a bear market. Bitcoin, which was supposed to provide some inflation protection, simply hasn't, and long duration treasuries have sold off by almost 20%. So you can see why many people are ruffled by this very sharp sell-off in risk assets at the beginning of the year. Now, lots of people have been talking about inflation spiking, and it's not just a single country phenomenon. You can see that during the pandemic, there was a fall in demand, then there was a huge surge in demand after the pandemic, and there was a limited supply of goods and services, which in turn led to very strong inflationary forces. So the US now has inflation of 8.5%, but you can see that in Europe there's similarly high inflation, Germany 7.3, the UK 6.2, and even France has a rapidly accelerating rate of inflation as well. And we also have to add into the mix the fact that central banks are now tightening policy. So if we look at the size of the Federal Reserve's balance sheet, it's now at $9 trillion, and it's starting its program of quantitative tightening. And unlike 2015, when there was a 2-year period between raising interest rates and actually shrinking the balance sheet, this time around, the Fed is slamming on the brake as well as pulling on the handbrake at exactly the same time. Rate hikes will be followed very closely just a few months later by that shrinking of the balance sheet. Now, in turn, many people think that that's going to trigger a recession in the United States, and central banks elsewhere may also accidentally create a recession in their own countries. So against that backdrop of smaller margins with higher inflation and a potential recession, there is a really uphill battle for risky assets like equity. Now, when equity markets fall, at a certain point, investors capitulate. In other words, they step back from markets. Now, the poster child of the euphoria that we saw in 2020 and 2021 was very much Robinhood, the brokerage in America. And at the latest Berkshire Hathaway meeting, Charlie Munger was typically very forthright in his opinions about Robinhood and what it did. He said that all the short-term gambling and big commissions and hidden kickbacks and so on, it was disgusting. And now they're unraveling. God is getting just. But it's not really about divine retribution, it's about people who've got burnt in the equity market just stopping trading. And that's very much what we've seen when we look at the Robinhood results for Q1 of 2022. Call options, which made lots of people millionaires when they bought options on Tesla, say, the volume in that market traded on Robinhood has fallen by about a third compared to last year. Cryptocurrency transaction has fallen by 40%, but what's really shocking is that equity revenue has fallen by 3/4 over the course of a year. And if you look at the actual report, what it says is that the fall in monthly active users was primarily because users with lower balances, presumably people who are new to the market, who are just having a flutter because of FOMO, were engaging less in the current market environment. So we've moved away from the situation where markets are going up, everyone wants to get on board, and that drives market prices higher. Now we're in the usual situation which is where we have to look at valuations, and those matter even more than usual. Now, valuation is something we discuss all the time in our Slack group on PensionCraft. If you want to join that community and become part of the conversation and learn more about investing from me and other people, then you can do that very easily on our website now, which is PensionCraft.com. If you want to learn more about it, just click on the link beside me and in the description beneath me. So given the fact that valuation matters again, let's take a look at where we stand right now. Beside me here, you can see the forward price to earnings ratios. So that's how many dollars people are willing to pay for every dollar of future profit forecasted by brokers. And that's a kind of measure of euphoria in equity markets. And importantly, it's mean reverting. It doesn't carry on drifting upwards. It usually comes back to some average level. Now, the really standout market in terms of euphoria is still the United States. So as of the end of April, you can see that the US was at a multiple of 19.3. That's well above the long-term average. Whereas if we look at Europe and Japan, you can see the valuations have been falling sharply, but they were also lower than the United States even before this sell-off started. So even if you'd have bought cheap markets before the sell-off, that still wouldn't have helped you. And if we focus on the United States and break down the valuations according to small cap growth and small cap value, so small cap growth is the blue line here, you can see that it usually trades at a premium to value, which is the green line, but the size of that premium is still extremely high by historic standards. So even though Cathie Woodsy type stocks have fallen, they've still got further to fall if we revert to long-term averages. So if you do have exposure to her stocks in ARKK, or you've bought those small cap growth stocks, then I'd still be worried that there could be further to fall. Another measure that people often look at is called the CAPE. That's the cyclically adjusted price to earnings ratio created by Robert Shiller. And instead of dividing by forecast earnings, we divide by the last 10 years of earnings, which is roughly one business cycle. It's pretty good at finding bubbles historically for the US, but here I've shown it for Germany, Japan, the UK, and the United States. And I've also shown the average for each of those countries. So you can see Germany is actually below its long-term average, and the US is well above its long-term average. So what we'll do in the next graph is to see what percentage of time each of these countries has been cheaper. In other words, we'll compare it with its own history. So that's what these bars represent. The expensive countries are on the right, the cheap countries are on the left relative to their own history, according to this CAPE measure. There wasn't any data for Russia, that's why it's actually blank on this graph. But for the US, for example, you can see it's been cheaper than it is right now 90% of the time. And that goes back to 1980. The Netherlands, India are also expensive. And the countries which are very cheap would include China, for reasons that we all know, but also Japan, because compared to those crazy valuations in the past, the current CAPE measure looks relatively cheap. But also Poland, which has been affected by the invasion of Ukraine by Russia, and Turkey, which is affected by its huge inflation, which was the case even before the rest of us saw high inflation. So it's certainly not true that everywhere is expensive right now. There are still pockets of value, although some of those are cheap for a very good reason. But if you are a contrarian, maybe you'll see value in those markets. Now, because valuations are mean reverting, we can look at where value sits right now. So here's the value of the S&P since the beginning of 2020, and these horizontal red bars that you can see show you where we are right now. So as I make this video, the S&P is at 4132, and what we can do is look at what would happen if the S&P went to, say, the 5-year average forward price to earnings multiple. Now, if that did happen, that's actually above where we are today. That would take us to an index level of 4406, which is 7% above where we are today. But we're actually above the 10-year average for the forward price to earnings multiple. So if that's considered fair value, then we're just a little bit overvalued. However, if we look at the long term, so if we look at the 60-year average of the price to earnings multiple for the US, that's actually much lower than we are today. We're still 14% above that level. That would take us down to 35.53. Now, all of these are measures of fair value. That's just the fair price that you'd get for the S&P given its future earnings. What would happen if markets really capitulate? In other words, we get to depressed pricing. Well, after the global financial crisis, the forward multiple on the S&P reached 8 times. And if that was to happen again, then that would take us below 2000 on the S&P. In other words, we'd have another 54% to fall. But I wouldn't panic because I think it's unlikely we'll get there. There's still quite a bit of euphoria and buying the dip in markets right now. But I'd say that was pretty much a worst case scenario. Now that all seems pretty depressing, so let's see that glimmer of light at the end of the tunnel. And that's expected return. Here's a tweet from Aswath Damodaran called the Dean of Valuation, and he's talking about this brutal month for stocks and bonds. So what he shows on this graph is two things. The first component is the risk-free rate, that's the Treasury 10-year yield, and you can see that's been increasing sharply over the course of 2020. So higher yield, of course, means that bond prices fall. At the same time, we've been seeing equity prices fall, which in his terms is an increased equity risk premium. So you can think of equity risk premium as the additional income you receive for taking equity risk compared to a risk-free asset like a US Treasury, say. Another way of thinking of it is that you're actually harvesting that risk premium by putting your capital at extra risk in the equity market compared to treasuries. Now, as equity markets fall, that risk premium increases. It increases the long-term return you'd expect. So over the course of this year, we started the year with a 10-year yield of 1.5% and a risk premium of 4.2%. Now, if you add those two together, it gives you a rough idea of what the long-term return will be for equity, and that was about 5.8%. But because both treasury yields have increased and the equity risk premiums increased, the expected return is now over 8%. So that's the good news. When equity markets fall, generally the long-term return increases. So if you're drip feeding into the market, that's really good news, because if your money's going to be invested for decades, then this is a good thing for you. However, Damodaran's of the opinion that the Fed's paying the price for not taking inflation seriously and early enough, and that as it raises interest rates and does quantitative tightening, we're going to see a US recession, and that's not fully priced into the S&P yet. In other words, equity will fall further. Another thing which he doesn't mention, which I think is likely, is that margins will also fall as inflation starts to bite on the input costs of companies, and that would reduce their earnings and also make it more difficult for equities to rally from here. So the good news is that when equity markets fall, your long-term return increases. If you're a long-term investor, that is. If you're drip feeding into markets, it's probably a good idea to carry on doing that despite the volatility. If you've got a large amount to invest, maybe drip feed. This is the kind of thing I discuss a lot during Power Hours. Also, don't forget our offer, which is to join our membership, which we now run off our website, PensionCraft.com. And if you want to learn more about that, just click on the link beside me and in the description beneath me. And as always, thank you for listening.